Alright, welcome to this training, and today we'll be talking about a very important topic in the trading industry, and that is market structure. But I would like to give it a bit of twist. You can call it the advanced market structure. Now, if you do not understand what market structure is all about, then you are most likely not going to make it long enough in the trading industry. And I'll also add a part 2 of the first series video I did some weeks ago on market liquidity. Now, first of all, based on all of our expectations, we have that if you are in a downtrend, you expect price to create series of lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, etc. And if you are in a swing or in an uptrend, we expect price to do series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and the rest. However, it is not always the case. This is what we expect for in a market structure, right? But this is not always what we see in the chart. So sometimes you see something like, and this is what I want to call advanced market structure. So when that normal one is not seen, the market would print, for example, in an uptrend, you have your lower low, for example, and then your higher high, higher low. That's your higher high. And then you see something like this, and then price goes that way, creates another higher high, pulls back, do series of movement, and create another higher high, and all that. Now, these internal ranges confuses traders a whole lot, and until you are able to decipher or to understand where your swing structure is standing, you would keep making those errors and those mistakes. So a lot of traders, once they see in an uptrend, they note price in an uptrend, and then they have price do something like this, and then they see lower high, lower low. They take this as a break of market structure or a change of character and expect the trend to change that way, only for price to do that, and they wonder how that works. So in this video training, I will introduce a concept which is not my concept, by the way, it's all there in the charts. I will introduce a concept to you, what we call external structure and internal structure. External structure and internal structure. Now, by the way, if you are dealing with market structure as a means to know your market direction or bias, then you want to actually play with the bigger or the higher time frames like the monthly time frame, the weekly time frame, the daily. I don't want to go lower than the H4. However, these concepts works in all of this time frame, even as low as the 1 minute time frame. You must be able to know when a trend is changing, when there is internal or external structure. So now let's look at these holistically. What do we mean by internal or external structure? So this is classic. This is an example of a 4-hour time frame of Nasdaq or US 30. Now, obviously, from this phase, we're in an uptrend, and then we want to now study this downtrend phase and try to understand what internal structure or external structure is all about. But just before we do that, let me give us a lead right here. Now, in a downtrend, you have price do something like the normal expectation, lower highs, lower lows. But in an advanced market structure, one of the things you want to take note of is in a downtrend, for example, price does this movement, pulls back, does a break of structure to the opposite direction, then goes this way. All of these pullbacks are what you refer to as internal structures. Internal structures are essentially the pullbacks within the main structure. Now, an internal structure, you may not be able to tell it is still an internal structure unless one of the sides of the external structures are broken. By sides, I mean, for example, in a downtrend this way, for example, in a downtrend this way, and the price start doing these pullbacks, that high and this low are the external structures, and they are the points to look out for. Should price rally and take out the high, then the probability or chance that the trend has changed is very high. Once price rallies in a downtrend and takes out a major external liquidity, takes it out with a body, not just a wick, then the chances that the trend has changed is very high. However, in a downtrend, price of course has that external high, external low, pulls back, does so many internal movement and breaks lower. This break lower further confirms that the trend is still continuing. So you do not want to mistake the internal structures or the internal, call them pullbacks, to the external. So you have to know exactly what your price range is. You have to know the exact swing point, or don't get confused or get caught up with the internal structures to the external. So let's look at examples to talk about this. Now this is currently Nasdaq, not a current chart though, but we just use this as an example. Now we want to study this phase of downtrend. Now I'm going to mark out the major swing structures that you know that, like I said, if price should take out any of those, it further confirms either the trend continuation or a change of trend. Right. So this high right there is an external high. It rallied down to break structure and formed that low. So that point high and this point low are very important points. Should price rally to take out the high, then there is a bigger chance that the trend has changed direction. Should price take out the downside, that means we are still continuing the trend. So in this example, we clearly see that price broke structure to the downside. So I'm going to be using a marker right there to denote that low. All right, and then we have the high up there. All right, we have the high up there. So we keep an eye on that area. Which of them gets taken out? Notice price pulled back and expanded to the downside. So we now have, once that occurs, we now have a new structural high. Now the pullback, because we're in a downtrend, the highest high right there in the highest high in the internal range or internal structure becomes your new swing high, right? Oops, becomes your new swing high. Then the lowest low before the pullback. So price rallied all the way down to this low right here, becomes your new swing low. Great. Now notice that between this high and this low, we had this pullback, and then we had this pullback. So a lot of traders will not see this, especially when they go to smaller time frame, will not see this as a break of market structure or a change of character. That, and then they are looking to buy, and then price go against them because you are still in a downtrend. Why? The major external high has not been taken out. Instead, this low was taken out. Can you see that? So the moment this low gets taken out, we now have a new swing or structure high, which is that high right there. We now have a new structure high. And remember I said a structure or a swing high, like in this particular example, can be taken out, right? But how did price close above that structure? That's how you know if it's a break of structure or a market sweep. In this example, that price was swept, but price did not break above. So you see price swept it, but did not break above with the body of the candle. And then we have a new swing low right at that low. Can you see that now? So all of these pullbacks, in this case that led to a sweep eventually, were all what? Internal structure. Internal structure. Until this area gets raided, then you can say for fact that we are most likely changing direction. And then once this low gets broken, right, your new swing high is now the highest internal structure high. It is now your external right there, and then how far the price um, go to. Oops, okay. Where is now the new swing low? Right there, right there. Okay, and then I can go on and on. We now have the pullback, which is an internal structure, and then once that low gets broken, this swing low gets broken, the trend continues. So that becomes your what? Your new swing high, right? And one of the things that this structure does for you, it gives you a range that you are trading. This becomes your what? Your new swing low. So wait for which of them that will get taken out. Obviously, after the swing low was established, we had all of this move. If I go to smaller time frame, and that is what confuses a lot of traders many a times. Smaller time frame, like 15 minutes time frame, you're going to see break of market structure, change of character, all of these other things that you have learned or you know that will indicate that you are in an uptrend. You don't want to fall for that. You want to mark out your major swing point from the higher time frame. I can go on and on, but I don't want this video to be so long, right? So you have that. Once this low gets taken out, you now have that area as the highest high there becomes your new swing point. And again we had price. I think there's this sweep across. Yep. So in this price action again, we have that swept across. So please note, when there is a sweep, that does not necessarily mean there is a change of direction. So you have price rallied all the way down here, right? All the way down there, and that is your new low. Okay, can we have, let me see if I can get an example of a change of direction, right? But then it is what it is. So notice you now have a new high, right? Right at that top. Until that high gets taken out, you are still in a downtrend. So I can safely put a whatever right there and expect that until that gets taken out, I am still in a downtrend. Can you see what I'm doing? Right? Now we can go on and on and on to showing that your ability to note your market structure, your swing point, will help you with so you will not fall for the short-term reversals, internal structures, etc. Now my chart is very messy. Now in the first video, or part 1, if you haven't watched that, and by the way, if you are gaining value for this video, please do well to like, subscribe, and share this video to other traders so they can learn as well. And all 1,000 followers of viewers at the time of recording, thank you. I see all of the love. God has blessed you. Right. Now, in the first part of this training video, which by the way, I'll leave a link right somewhere around this video, we talked about a simple reversal market structure where we said you have, for example, in a downtrend, right, a sweep of liquidity, a break of market structure, then you have price do something like that. All right. And we also emphasized a very simple part of trading where we see price grabbing liquidity. And by the way, we know that price moves from one level of liquidity to another. So in that other video, we talked about price doing something like this. That high should be taken out. Price rallies, takes it, and decline. Now, in this other part of the video, I'll be talking about the order liquidity pattern. This will be like a part 2, and it is something you can actually trade with and give you insane risk to reward ratio. And what is this pattern? It's like an hybrid of the first one. By the way, if you haven't watched the first one, again, I'll leave the link somewhere in this video so you can actually access that right away. Now, this is like a part 2 or a hybrid of the part 1. And what is it about? You want to see price create this kind of movement. And I like this a whole lot. All right. And then once they take out the big break market structure right there, that second high, you want to see price rally to take it out and then decline. I'll draw that again. So it works this way, that in a downtrend, for example, you have to know your trend. You want to see price create a high, create a second high before breaking market structure, right? And then expect that second high price will take it out, and then decline. The question would be, how far will price have to run after taking the second high, or in an uptrend the second low? So in an uptrend you have something like this. That way you want to see price come down, take this, you are buying from that level and you are taking profits right there. How far price will go in taking after taking out this liquidity, right, would actually be the question of whether or not there is a fair value gap or an order block above or below price. So in a downtrend, you have price do this and that. You expect that level to go. If there is a fair value gap above or an order block above, expect price to take out that liquidity, rally or tap into the fair value gap, and then decline. Your stop loss will always be here. In a buy scenario, your stop loss will always be there. Now, the way I process this in my mind is this, and you may want to consider that as well. Whenever, let me take out this line. Whenever you have a series, whenever you have two highs or two lows formed, for example, high number one, high number two, and you're in a downtrend, expect the number two, the second one, to go. In an uptrend, you have two low from low number one, low number two, expect the second low to fail. Right, because liquidity is the fuel of the market, and price will have to grab liquidity before it continues in a direction it wants to go to. Of course, we have a name for all of this, but I will talk about that in the next video, in which I will call part 3, or the final part. So if you're still not yet subscribed, please do that right away, so when I do that upload, you'll be the first to be notified about that one. But this one currently we are discussing is actually my favorite pattern, trading the liquidity pattern. Now I will go to current. As at the time of recording, there was a current trade we took from Nasdaq, and I think I will use that to explain this point. And your task is to, my own job is to show you all of how this looks like. Your task actually, amongst other things, is to backtest. Right, is to backtest. I've not even gone to the current price action, but look at what I want you to see. Look at, there's a sweep of liquidity right here, and price created low number one, low number two, broke structure. So what we see there, right, was something like the sweep of liquidity. Price went that way, came down, went that way, right? So we expect that to fail. Price have to come back, take it out, and go. And did that play out? Yes, it did. Sweep of liquidity right there. Low number one, low number two, broke structure to the upside. So we expect low number two to fail. So price came back, took it out, and boom, look at the reaction. Beautiful trade. Notice this is even the 4-hour time frame. I haven't gone to a lower time frame. Right, now I wanted to show you a recent top, but that just popped out. You see, the more you train yourself to this, you are going to be seeing it over and over and over again. Right, there's another one here. There's another one here. You have your sweep of liquidity to the downside. Price rallied, yet it didn't break that structure yet, but the pattern presented itself. So you have the sweep, your low number one, and your low number two, and then price broke structure to the upside. So you expect that low number two to fail. And notice, almost every time, if price takes out that second low, right, the expansion, the reaction is phenomenal. All right, okay, can I hold back myself and go to a more recent price action? I can show you this all day. In fact, I think in our website we did talk about this in one of our recent material we sell for $4.99. It's actually the strategy we talked about in that material, so you can actually get that if you want to, but it's not a prerequisite, right? You are learning basically all of that for free right here. All right, so by the way, if you want that, I'll also leave a link in the description channel if you want to get that material for $4.99. Look at this one. This is a recent trade, like you can see at the moment, panning out. This is sweep. I will zoom. Okay, let me zoom in so you see that more clearly. You want to backtest this. This is a very simple liquidity pattern. Again, you can draw this somewhere in your chart. you want to see a sweep and then a break. I expect that second leg to go. Price takes it out. I am buying. All right. For a downtrend, you want to see a sweep and then a break. I expect that second high to go. So price comes, take it out. I am selling. Simple, simple stuff. Simple stuff. Look at it here. We have the sweep. Again, this is the 4-hour time. Of course, if I zero into smaller time frame, you see all of it. It's happening at almost every time. All right. This works in any pair and not at all pair. So you have that little bit of sweep right here. Price rallied. Notice that high that price went to take out. Now on its way to taking out that high, it created the low number one, the low number two. Of course, it had something right there, but in this case, we are looking at the second high or the second low formed. And notice how price reversed. If I go to smaller time frame, I also have the same setup happened right here. And I may not go, okay, I will share with you that after I'm done with this one, finally, to end the video. So you have this second low. So you see price rallied all the way down, took it out. My stop loss was here, and boom. All right, I am actually aiming for that high to get taken out and then up to the fair value gap above. If you don't know what fair value gap is, again, I'll leave another video for about a 1-hour training video where we'll talk about every single concept, the order block, the fair value gap, the everything you need to know essentially. I'll leave a link in this video as well. So that's the fair value gap above that we expect price to take this liquidity out in this buy and then fill, and then it might continue the downtrend. Right. So let's go again to a smaller time frame. Let's see the 1-hour time frame. I will show you something from there as we conclude this video. Once again, if you are getting a lot of value, please do well to show some love by liking, sharing, and subscribing to the YouTube channel. So this is the 1-hour time frame, and this is the reversal trade. You see it happens both ways. Notice that high swept liquidity somewhere, and then it's created a first high and then a second high right there, and then price came down, pulled back, creates a high right there. We expect that high to fail. So you see price came, took that high out. So what essentially happened there was you have a high, then price rallied down, went up to create another high, came down this way, then we went up to take out that high and then came down. Right? It's the same thing, just an hybrid of course of what we are learning. What we learned from the beginning, the structure formula is something like you have it this way and then expect that to fail and go. But you can also pan out this way, right? And then price come down, create this. Whether or not this low is taken out does not matter. That high has to go, and then it goes. Are you getting it? So second high formed after the first one will almost certainly fail, especially if you're in a downtrend. Second low formed after the first low will most certainly fail if you're in an uptrend. I think that simplifies it pretty well. So we have this high formed, 1, 2, and then price came down. Notice this high took out. Notice how this one took out this one, but yet did not take out the main high, and that is your catch. And then it pulled back and then did all it. Now I told you can cash it both ways if you know just what you are looking for. I'm going to end the video right here. I do hope you have gained value for your time. What I will encourage you to do is to practice. I just taught 2 things. In summary, the first is how to know your market structure. How to know your market structure. And in this particular example, even what you are staring at in my screen, this could be your swing high, your swing low, and that's your swing high. All of these pullbacks are what? Internal range structure. Why are they internal range structure? Until this low gets taken out, we have not changed direction. So that is your high, this is your low. Now price pulled back internally. Now it is rallying back. All is still internal. Once this high gets taken out, which I expect it to do, then we're actually in a short-term uptrend, because from the 4-hour time frame we are still in downtrend. And I will say price to pull back, take something from this area, which I already taught you how to take that trade, and then expand there, and then probably before we now have the downtrend. We will build on this in our next series of videos, which I'll call the part 3. Before then, please do well to like, comment, share on this video. Let me know if you are gaining value so far. And if you haven't watched the series of videos I did recommend, please do well. They'll be showing in all of the at the end of this video. All right, until I come your way next time, I am Jay Okoli, and I'll see you on the next video. Cheers.